Us here on The Open. I'm John Ehrlichman, and we've been watching the markets this morning, trying to decide if they want to step in or continue to take a breather after that big sell-off yesterday. And with a big decision this week for the U.S. Federal Reserve, as we've been talking about all morning long. Tomorrow we're going to get the U.S. Fed's latest interest rate decision. Some thinking perhaps they're more aggressive than a half-point move. 75 basis points is some of the buzz now on Wall Street. Michelle Schneider is Managing Director of Market Gauge Group, and she's been kind enough to join us this morning. Mish, it's nice to see you. I guess let's just start there on what your own expectations for this Fed announcement are right now.
I may be in the minority here, John, but I'm actually thinking that they may stick to the 50 basis points because basically that's what they have said that they will do. There are other Fed members, of course, who have suggested 75 basis points or even up to 1. But I always like to listen to what Powell says, and I have not seen him waver from the plan of the slow raise of the rates, aware, obviously, of inflation, and the numbers today were maybe a little bit cooler than what expected, but of course they exclude food and energy, so I find them to be somewhat irrelevant, those numbers. But whatever, I really kind of think that what he may do is the half a point and then continue with the narrative that we're going to do it again in July and we'll do it again in August, and we keep doing it until we get things under control rather than trying to shock the system. I could be wrong, of course, about it, but that's just my kind of gut feeling.
I liked what you said about under control, because I'm trying to figure out and piece together where we are in this market cycle. Like, we've gone through everything. People know what is potentially in front of us and the different scenarios on how this ends. And I guess they're trying to figure out what strategy leaves us in better shape than not. And do more rate hikes right now help to address this inflation monster faster, or do they lead us into a more tricky economic picture faster? So, I mean, I guess it's anybody's guess at this point.
Well, I'd say no and yes. Okay, so no, that I don't really think that raising the rates faster could do all that much for the two areas of inflation that we have talked about over and over and over again, and that is food and energy and oil, because we have a real supply side issue.
Right.
And I like to say at that point, that's not supply chain, that's different. We have a real shortage of raw materials when it comes to food, and we also have a war inflation situation. The Ukraine-Russia situation is not exactly stopped at this point. And of course, we know that that's really going to be a negative for food and for energy. So raising rates, what is that going to do? It'll do the yes to the second part of your question, which is maybe drive us into a recession or worse, which we're not there yet. And we do have some positives. It's kind of a weird positive, but the weird positive is that we were so shut down just a year ago or so, that the fact that we've come back from that, we're in a stagnation, but that doesn't necessarily mean that we're going to go as bad as we were, which was completely shut down. We're just going to stagnate, and that's what we've got here is stagflation. So to me, if I were Powell, I would keep the slow and steady, maybe that understanding that it's going to be hard to control the food and energy, but at the same time, it's going to hurt people both ways.
Yeah.
Those costs won't go down, and we're going to raise rates and make it really impossible for people to move around because things are so high in terms of interest rates. Hedging is a Wall Street term, but we do it in our life. If something costs too much, right, you might find something that costs less. I'd argue that is, to a certain extent, finding ways to keep your costs under control. Canadian market investors have been watching the surge in some commodity-related stocks this year, including a lot of those energy names. And so even though we've seen this correction of the TSX, broadly speaking, down more than 10% from its peak, it's fared better than the U.S. markets because overall it has less of that tech exposure. How are you thinking about the areas that are best positioned for either less declines or some potential upside in a market where there's just downright gloomy headlines daily right now? It's such a great question, because first I'll just say very quickly that anybody who thinks that these big companies like Microsoft, Apple, NVIDIA, et cetera, are great value down here. I think they're going to be in for some sticker shock because they can go lower, but more importantly, how much higher are they going to go? It could take years, especially if you're long from the higher levels, to recap, to break even, let alone make money. So what can make money right now? I still really believe that China is in its own universe. They're actually doing QE while we're doing QT. Yes, they're back into somewhat of a shutdown, but I like FXI. We're in FXI. We probably will add to that at some point. And then some of the tech companies, I'm particularly interested in PDD or Pinduoduo, if I'm saying that correctly. I also think that we have to keep an eye on commodities, basic commodities, DBA, which represents a lot of food, wheat, corn, soybeans. This dip is probably still a buy opportunity. In terms of oil, we're at 124, almost $124 a barrel. I don't know if I necessarily would want to keep buying at these levels, but some of the dip, maybe like in coal companies like tech or what have you, might be good. And that brings me then to solar energy, because I still think at some point people will say, wow, it's still so cheap relative to classic oil and energy, that there's going to be an opportunity in things like TAN and some of the solar stocks.